Hi, welcome back to section 2 of 4 videos for chapter 10. I believe I said to you that there would be 3 videos for chapter 10, but in fact there's 4 because I had to split the third video, it was too long. Let's begin and use the table of contents on the left to toggle from slide to slide, so you don't have to always come back and watch the whole video. So we're only going to do one study objective this time. It's why are bonds issued and the types of bonds. Bonds are loans that companies get. They are long-term debt. They're loans, and they're a specific type of loan. The company borrows money. They issue the lender a bond, a piece of paper called a bond. The lender is called a bondholder, and the company pays the bondholder interest. And there's a big legal contract with the bond. And involved in that is an explanation of how interest is paid, either annually or semi-annually. For this chapter, it will be semi-annually. And most of the corporate bonds are semi-annually. And then it'll be a lump sum payment at the end of the borrowing period. So let's say a bond is 5 years. Interest will be paid throughout the 5 years and then a lump sum at the end. Now, a company can structure a contract, which you should know from business law, any way they want. But what we're studying this chapter is corporate bonds, and they tend to follow a certain pattern. Semi-annual interest payments, lump sum at the end of the year. Lump sum at the end of the borrowing period. Nope, not this bond. We'll put a few pictures from the Bond movies out here, but in fact, they're not. We're not going to be talking about James Bond. I like to put them on this PowerPoint presentation because it makes it fun to see those and kind of compare them to the debt bonds. Here's an old-fashioned bond issued in 1956. It's a 20-year General Electric bond. And I want to point out to you the face value of the bond is what is printed on the bond. And make a note that term face value is real important. That is what the company will pay back the bondholder at the end of the borrowing period. You can see on this bond it's a 3.5% interest rate. And that means annually we pay the bondholder $35. Now most bonds, and in fact the bonds you will be studying, are semi-annual bonds. And so most bonds would pay the bondholders twice a year. And in this case, if that were the case, it would be $17.50 every 6 months. This bond is a 20-year bond, so they would pay interest for 20 years. And at the end of the 20th year, the bond would be paid back at $1,000. Why do companies issue bonds and not common stock? There's 3 advantages to bond financing. You know, a company needs money, so they go after financing, and they're going to borrow it through a bond, issue maybe 5 million or 10 million in bonds and pay interest. Or they're going to issue new stock, maybe a second round of stock issued, and that would be equity financing. So first advantage of bonds over stock. Issuing bonds brings money into the company, as does issuing stock, but it's debt. It doesn't bring owners into the company, it brings lenders. So lenders do not get a vote in general. Owners do. So if we issued stock, we'd have to allow more voters into the company, which would mean loss of control. So bond is better because it doesn't increase the number of voters. Another advantage is lower tax expense. Interest expense is deductible. Currently, dividends are not. So if you do stock financing, and you pay dividends, you can't deduct that. But if you do bond financing and you will pay interest, that is deductible. So that lowers your net income, which lowers your taxes, which is always a good thing. Earnings per share. We'll do a calculation at the end of video 4, and I'll show you how this works out. But having less stockholders increases earnings per share. Can increase earnings per share. There's a lot of factors in this, but it can increase earnings per share. So that would be the third advantage. We have Four different categories of bonds, and there are more, but we want to go over these. Secured bonds would be where the company would issue a bond and they would actually secure it with an actual asset. So, for example, they might issue a bond and pledge a building or a piece of real estate, or even a separate bank account called a sinking fund where they're putting money in for the purpose of paying back that bond. If the company defaults, the secured asset would go to the bondholder, kind of like a home mortgage. Unsecured bonds are called debenture bonds. Unsecured bonds are called debenture bonds, and they're issued against the general credit of the borrower. So if the company defaults, there's no asset that gets pledged. Term bonds, and again, that's what we're going to be studying in Chapter 10. They are due for payment at a single date in the future. This is in contrast to serial bonds, which would mature in installments. So if the company issued $100,000 face value bonds and they paid them back over 4 years, they could pay them back $25,000 a year, maturing in installments. Registered and bearer bonds. Registered bonds are issued in the name of the owner. They are tracked by the owner. Bearer bonds are unregistered, so they're not tracked by the owner's name. They are also called coupon bonds. Convertible bonds. Again, all of this is in the contract, so you would want to read the contract. And by the way, the bond contract also has a special name, and we'll get to that in a minute. Convertible bonds would be bonds that could be converted into stock. They start out as bonds, and the bondholder makes the decision to convert them into stock. Why would they want to do that? They would lose the interest payment. Well, if you have a startup company and it gets through the first 2 or 3 years and it looks like a successful company, the stock price was probably rising at a faster rate than the interest rate, and that would be an incentive to switch. But that's the bondholder's decision. Callable bonds would be bonds that could be retired early at the company's option. So the company, let's say, and why would a company want to do that? Let's say they issued a bond at 10% interest, and it's a callable bond. But now the market's dropped and interest rates are more like 7%. They would call in the 10% bond and reissue a new bond at 7%. So what's that funny name for the bond contract? It is called a bond indenture. A bond indenture. Probably a term you haven't used before. So it's the bond contract. We don't say the bond contract, we say the bond indenture. So the board of directors for a company approves new bond issuances. So for example, if the company's trying to raise $5 million in bonds, they would authorize 5,000 bonds at $1,000 par value or face value. Those terms mean the same thing. Inside, in the contract, the bond indenture, it gives all the terms of the bond. What is the face value of the issuance? What is the interest rate? The interest rate is called the contract rate, the stated rate, or the coupon rate. When's the maturity date? What's the life of the bond? So again, interest is calculated on face value. So if we issued $5 million in bonds, and by the way, that would be 5,000 bonds, the face value for bonds is $1,000. The face value for bonds that we are studying is $1,000. So if you need to raise $5 million, then you issue 5,000 bonds. If you need to raise $10 million, you would sell 10,000 bonds. So if we had $5 million in bonds that we sold, the company sold, and the interest rate was 8%, annually it would be $400,000 that the company would pay in interest, or $200,000 every 6 months. Lots of money. So here's a look at a bond, General Electric Company, and you can see that same company that we looked at before. You can see the issuer, the General Electric Company, the maturity date, the contractual interest rate, and then the face value of the bond is $1,000. So how do you keep them straight? We got two terms that look very, very similar. Indenture is the bond contract. Debenture is the type of bond. Okay, this is kind of a stretch, but I like to show this. When the Pilgrims came to America, Some people couldn't afford their own passage. And so what they did was they would say, I'm over in England, I want to come to America, and but I can't pay for myself to be transported to America on board ship. So I'd go to a rich person and I'd say, you pay my way, you pay my passage to America, and I will work for you for free for 7 years. I signed a contract, and I would have to work for 7 years for that rich person once I got to America. So those people were called indentured servants. So that's a contract. Some of you may have studied that if you studied American history. Debenture. Okay, one of my very favorite Christmas movies of all times is Die Hard, number 1. And this all happened at Christmas. The movie was set. But there's a scene in the movie where the bad guys are robbing a bank because inside that safe in the bank was millions of dollars of debenture bonds, bearer bonds. So Die Hard starts with a D, debenture. So debenture bonds, debenture refers to the bond, and indenture refers to the contract. All right, this concludes section 2. Go on to section 3 and 4.